really great. We have Kilian Graulich, who's going to be speaking about his work advising family offices on investments. I asked Kilian to come in specifically to talk about that. He's also an advisor to a GP of Prediction Capital, so he'll be telling us about that. Then we have Nikki Sevim of Johnny Tech. Where's Nikki? Nikki, you'll be on right after Kilian, okay? And then we have Root Technologies from the UK. Jason Beresford, so I hope that Jason is in the wings here somewhere. And then we will look to round up the day with Theo Ratcliffe, who is, I know, here somewhere. So we have four presentations here before the end of the day. And then we have a number of people joining us for their reception, which will be here at 7 o'clock. Okay, so without further ado, Kilian, thank you so much for joining us today. And you know, I always ask everybody to speak about themselves, so don't be humble, don't be shy. A little bit about yourself and why you are doing what you do. Kilian, please welcome Kilian Graulich.
Thank you, Julie. So yeah, super glad to be here. My name is Kilian. I'm originally from Germany, but now live here in Zurich. I have a background in management consulting with McKinsey and private equity, working for some large US and Nordic funds, basically, and then eventually slipped somehow into the family offices and private investor community and scene. And ever since have been advising now family offices on particularly private markets, but also the investment strategies. As Julie said, one of that included that I helped two Swiss families co-found Prediction Capital, which is basically their in-house early stage strategy that they operate with basically their own money particularly, but also with family and friends money of other European family offices, both from the German-speaking countries, but also from, for example, Eastern Europe. I will be talking a little bit about how I, based on my experience and my conversations, observations, view European venture capital scene, what I see as challenges and opportunities, particularly for family offices and also private investors. But before that, like, I have basically three biases, obviously. So one, I'm German, and therefore I like things that are efficient, rational, and logical. Second, as you can see, I'm quite young, so I rather like looking forward into the future than backward into the past. And third, I love private markets. But as of now, I like private equity more than venture capital, where it stands as an investment class. And I'll tell you later why that is. To start with, and I'm pretty sure some of that has been covered already, I've been reading it in the news, but I think as I see European venture capital right now, there's a couple of challenges that definitely need to be overcome. I think one, and that was being discussed earlier, is there is a lot of technology here, but I will not go into the discussion of superiority here, but I think one thing is clear: we are way too shy and way too non-bullish to advertise on that. While you see a lot of screaming and loud voices from the US on their successes with all this great technology. I mean, in Germany, for example, we have Aleph Alpha, which is proven to be at least as accurate as OpenAI or ChatGPT, but no one's really talking about that. So I think that's one big challenge that we have in Europe in general when we talk about technological sovereignty. And then the second part is really that, as you can see now, all of these large US GPs, they are opening branches, particularly in London, coming here with loads of money, coming here with the promises of, we'll not only invest here in Europe, but we'll take you to the promised land of the US market. And that's obviously very attractive to a lot of investors, particularly since we have a scarcity of money, especially the growth stage. So I see that as a big challenge for European GPs. I mean, let's take an example here, German GPs, which have now raised very large funds like 2x, 3x, but they have nowhere to deploy it really in their current realms, because on the one hand, the market is not at the same time for startups growing at 2x or 3x or 4x, but also they are being increasingly pressured by now Asian funds coming in, particularly US funds, that due to their brand image, their capabilities, and after all also their liquidity, provide a great challenge to these funds. And this is also one discussion that I have a lot of times with the family office that I advise is it reasonable now to invest into these newly founded vintages of these larger European GPs? And usually my answer is, I don't think so, because I have a hard time believing that these funds will be able to create values and returns in the same instances as they have had when they were in the one smaller and also more hungry to really drive change and invest into the right companies. At the same time, what I truly believe to be quite exceptional is that there is a very large number now of emerging fund managers in Germany that, and also Europe, that are very niche, that are really tech savvy, that are not necessarily founded by ex-investors, ex-consultants, ex-founders, but by engineers, PhDs, who really know what they are doing, and they are being complemented by exactly these investors. And there's amazing funds in the deep tech space, in the space tech space, in the health tech space, in the AI space, you name it. So that gives me a lot of hope, and I truly believe that also the return of these funds can certainly be exceptional, definitely more exceptional than what I see when I look at most of the returns that the larger funds are able to achieve and also ultimately distribute, which has become increasingly important, obviously. At the same time, what I obviously, when I look at opportunities, get asked a lot of times is the whole AI thing. I mean, I'm not an expert in AI, but I think based on my observations, I have one very strong hypothesis for AI in the Europe for non-super duper AI savvy investors, and that is stay away from the whole application area for now, because I think it's super complex. I mean, you have probably also heard that ChatGPT has now opened their own basic app store, which will drive a lot of disruption in that sector. And so the question really is, will the new layer, the application layer, be fully spread and developed on the basis of a few winners that drive their own app stores, on their own databases, on their own codes? Or is it that there will really be so many activity and so many also companies that will be able to be successful next to OpenAI, ChatGPT, Alpha, and so on and so forth? And that's, for me at least, very hard to understand right now. And that's why I stay away from that. However, where I have a very high conviction and where I also invest a lot of my own money is in the niche market around that. By that I mean companies that are able to build proprietary databases and AI LLM models based on really a niche case where they can have an edge. For example, there's one company I've invested into that are doing that for ESG compliance in consumer products. If you hear about it, super small, or you think it's super small at least, but it's actually a multi-billion market. There's lots of change happening in compliance. Big companies like Nivea, Nestlé are being sued because they're actually not producing ESG compliant product packaging and so on and so forth. So that's rather something where I currently put my bets in, and you can take it for what it is, but at least that's a little bit my view on that. Plus the infrastructure around it, especially companies that are making big leaps in terms of how to curate, create, and also adopt the databases on which these AI models are being trained, and also then the whole infrastructure around the actual training of the AI, which can be large data server farms, which can be also, again, code on an additional layer of that. So that's a little bit how I see that, and where I'm having a lot of conversations with the investors on my end. Another thing where I have lots of hope in general right now is early stage investing in general, particularly in Europe. I think this year and the next year will probably be the two best years to do that. And albeit a lot of the families that I work with have been burned quite heavily in the past, especially driven by the next generation that Julie was mentioning earlier, there's new hope and new drive to give it one more try, basically. So I think in Europe now we have one more chance basically to fix a few of the issues that we have had when we had the high in the past last years, when a lot of those private investors got burned, to now get them back into the market, get them back into very attractive companies, both in the early stage and the early growth stage, and then capitalize on that. At least that's what I'm trying to do on my end, and where so far I see a lot of success in taking these families on the journey, instead of having them on the side life, really keeping them integrated, letting them leverage their networks that they have from their family businesses and the industries that they are active, and thereby making them invest. Because as also Marcus said, like especially in Germany, Austria, Switzerland, there's a lot of skepticism, there's a lot of risk aversion, so families will not naturally go on that journey. There will need to be people from the VC scene, from the investor scene, that will take them by the hand, reassure them, and then also have them actively participate, and most importantly, be super transparent and honest with them when it comes to reporting both successes but also losses. Because that's something that these families ultimately need to learn. There is losses in venture capital, and it is okay to fail. And you can still talk to your other rich friends over barbecue how this investment got completely dumped and what you've learned from it. But it's equally important to do that as in sharing the success stories after all. And in addition to that, I think another thing where I see great opportunity, but again, it all boils down to the same results and the same actions, is the opportunity now to finally get the larger LPs, as in the pension fund, the insurances, on that same journey and make them open their very large buckets and dry powder that they are sitting on to invest into innovation, technological sovereignty in Europe, and to actually bring the capital to work that has been lying around there for ages in some weird fixed income bond strategy that is not really yielding anything. Last but not least, I think one thing, and was my third bias basically, I think there is a lot that venture capital is currently learning from private equity. And why is that? Because the large PEs have also understood, okay, to actually be able to drive value creation for our large buyout firms, we need to understand what's coming next. EQT is an amazing example here. So EQT, for those who don't know, it's one of the largest PE firms in the world, like almost 60 billion under management, originally from Sweden, originally also founded by a Swedish family. So they have, in general, in the Scandinavians, an amazing example of how family can actually create those ultra big GPs. And EQT learned one thing, because when Airbnb came up, EQT didn't know nothing about it. And at the same time, they had, through their real estate strategy, a really, really big allocation in Scandic hotels. And this investment went completely to hell because of the disruption that Airbnb brought. So consequently, what they did is they developed something which they call their mother brain, which is basically this big crawler that goes all throughout LinkedIn newspaper articles. And at first, it was just to understand what new tech disruptions might come that they would need to take into account when making investments, when leading their companies. But eventually then they found, actually we can also invest into these companies and take them onto our journey. And that was the moment when EQT Ventures, EQT Growth was born. And now if you Google EQT Mother Brain, you'll see that actually this technology has become one of the most important parts in the deal sourcing process and innovation sourcing process for both the venture and the private equity part. And the more these private equity companies come in, like EQT, like Blackstone, that all have now at least their growth, but sometimes even their early stage investment vehicles, the more knowledge on, for example, debt capital markets, secondary markets, is actually being brought into venture capital, which makes this asset class more sophisticated. Because let's be honest, venture capital hasn't been really sophisticated in the past years. That's why you had those big bull runs, those big burn runs, those big bear runs, and nobody really wanted to make sense of it. People were just chasing new highs, and then when the low came, they were like, nobody could have foreseen that. Well, a lot of the bubbles can actually be foreseen, I would say. And this is my last big hope, basically, that a lot of the lessons learned that private equity as a much more mature asset class has been made throughout the past years are now being transferred to venture capital, and thereby venture capital will eventually become a more investable asset class to family offices, to private investors, to larger institutions. And I hope I was somewhat in time. Thank you so much for listening to me.
We need the other microphone for Kilian. No, that was great. It was snappy and some good insights there and so forth. And you kind of touch on something that I think is quite important, is the kind of cycle and the supernova effects, right? In London, in the London market, you had lastminute.com, which was founded in Easter weekend 1998, and lastminute.com became hugely successful, the IPO, but it created all of these spin-outs, right? And you could write a book on European venture capital and internet on just lastminute.com, but then if you take the top 100 of internet companies like that, and so you touched on some of the some of that circle there, right? And many people don't know that in SES Astra in Luxembourg, which was founded by a good friend of mine, Countess Johnson, created so much GDP for Luxembourg, just so much, that it created then a whole cycle of innovation, Mangrove Capital, Skype, and so forth. And people don't connect SES Astra, satellites, Skype, and so forth, but it's the flows of money inside of countries. So tell us about the two Swiss family offices that you got to put money into Prediction Capital, and don't say that you're not going to tell us the names, because we're not going to let you leave until you tell us the names.
No, I mean, the good thing is about them, they are... Sorry. The good thing about them is that they are really, really open and out there, which is not necessarily the case for Swiss or German families. But basically, how it all came is I was introduced by a friend of mine to one of the family offices, which is called Infinitas Capital's family office in Basel, by the Lauber family, who made their money in real estate, basically. And they were asking me at that time, could I help them with their private markets allocation arm? They wanted to do more in venture, more in private equity. And at the same time, they had a lot of other families that also wanted to do venture as well. So there was another family, which is the Schufar family, which is originally from Lausanne. They built one of the largest telco and IT infrastructure companies here, sold it once to a strategic. They screwed it up. They bought it back, restructured it, fixed it, sold it again to another strategic. So quite an impressive entrepreneurial story as well. And they got together and basically asked me whether I could help them with the strategy, also helping them get access to the German market. And yeah, that was basically the origin story of Prediction Capital. Ever since we've done 9 investments now, mix of Germany, Switzerland, France, and the UK. Pre-seed and seed super early, very bullish on particularly themes within fintech, ESG, and also B2B consumer tech. And yeah, I mean, I think the most important part here was also to get other families to join, was exactly what I just said. It was not just giving them an opportunity to invest into venture, but also to really let them participate, let them co-invest, not when it's already too late, but in the same rounds as we would get in, or at least in one round later, get them in touch with the other families, get them in touch with the founders, make them open their networks proactively. Like, for example, one of the companies, they gained 3 customers from only one family that we connected them with.
Wow.
And I'm not talking like small SMEs, I'm talking really 500 million plus in revenues customers, which usually would take forever to convert in a B2B sense, right? But I think was the strategy from the very first part, and that was also what got me excited into the project, because just investing would have just been too simple and too boring.
It's very impressive what you've done. So tell us a little bit, how are you doing this? It's really good what you're doing. How are you getting the confidence of people that have been these family offices to, it's not, there's probably, a good 10,000 people who would like to advise Swiss family offices on their private market strategy. Tell us how you're doing it.
So, I mean, first, my first contact was through one of my best friends, who basically got me in touch with one German entrepreneur that I then helped to buy a business. And that was just warm intro, just also confidence in my abilities based on my prior engagements. But then I think at some point it becomes a self-fulfilling prophecy that you get in touch with families and that you get the trust, which is if you have other families that can already vouch for you, and B, if you're just being honest and transparent the entire time. And I think that's something that is unfortunately a lot of times very rare in the family office industry. There's a lot of people going around pitching stuff, selling stuff that is just not attractive, and where there's no aligned incentives, as in, for example, I get a management fee, whatever happens, and I'll leave you to it. Like what I do, for example, is whenever I get engaged with a family and I advise on a deal, for example, I always propose to them, hey, I will invest half of my fees immediately with you in that investment, or I would like to reinvest some of my money and then I get a deal carry on it. So I always want to be in the same boats with the people. I'm being super transparent, I'm being honest, I'm being trustworthy, I'm being very confidential with anything that they tell me or whatever. And last but not least, I think I also then started at some point organizing events that were just exclusively for family offices. No sponsored allowance, no people that would pay money to be there, just family offices that spend amazing times together, get to know each other on a social contract. And that was, I think, really one of the main catalysts as well to build that trust, build that network.
Very good. Excellent. Outstanding. Questions for Kilian? Questions? Yeah, we got David here. Yeah.
You said that they're ready to give maybe it another chance, that they are burned in the past. What makes you think this time is different?
That's a very good question. I love that. I think the easiest answer is timing. So most of the family offices, at least in the DACH region that I know of, that got burned, they got burned in the hype cycle. So they were investing when, after COVID, VC was all over the news, people were bored, people sat at home, they had nothing to be excited about, and there was something to be excited about, which was venture capital. And unfortunately, that's when most of them invested. And as we all know, That's where most of the money was eventually burned and lost. Now it's different, right? Now you have a time where, particularly in the early stage, valuations have come down. Many people understand now it's not all about growth. Actually, profitability is a factor. Surprise, I wouldn't have thought about that. And where also there is, I think, now a whole different environment also from a political standpoint as well. So I mean, in Germany, we made big leaps now, I think. There's still a lot of leaps to be made, but to really also activate state money, to activate, to make it easier for founders to found companies. We are currently having a big ESOP revolution, which is not yet, but at least it's getting there. So I think that's where that drive comes.
Now we have 3 companies that you haven't heard because you weren't here earlier, but just to go through, yep, I'll take the mic and then we get that mic to you. There were 3 companies here. I'm just thinking about, let's just play, a game. Let's say that Rajan Kumar, who was the battery company, and he said it's not just about revenue, it's about impact and being able to show. We had the Spectrum company, which is built an incredible IP portfolio, and again, it's they're possibly going to be sold to Google or Qualcomm. But it's not just about revenue, and also there's a number of companies here that are presenting which are really good bets. The entrepreneurs absolutely know what they're doing. They've done it before. But they can't just simply show 3 years of audited accounts with EBITDA growing each time. How do you get the message across to the Swiss family offices and the German family offices that have confidence in you that these companies can be doing a different kind of market adoption, market entry, impact, that is non-standard? It's not just about EBITDA as fast as possible and so forth. There's other things that they've created which are about the reasons why they're going to get acquired or the impact that they're having, a variety of things. I don't need to go through all of them, but it's not just chop, 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 SAP, chop, 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 and then now we're worth 25 billion.
Yeah. So I think in the end, what people that aren't working with family office regularly have to understand, everything takes time, and the more common ground you can find in investments in VC, the easier it will be to basically make family offices invest. So usually what I try to do to make it not about the EBITDA, but make it about other factors. For example, hey, this startup operates in an industry that your family business operates in or used to operate in, where you can actually provide great value to that startup, and where just by you coming into that investment, your own risk would be hedged through your network, through the industry experience that you bring. That's one thing. So I'm trying to basically make, in general, as many levels of uncertainties and reasons of uncertainty that you will have in venture eventually disappear by showing common ground, showing parallels, and overcoming those mental barriers that most of them have. And then it's all about also, to some extent, selling them that VC dream, right? So showing them other companies have achieved that. Actually, this business case with some adjustment actually shows that the company can eventually become profitable. So I'm just doing my own due diligence on that, and I'm being very harsh, especially on the financial side of things when it comes to unit economic pricing and so on and so forth. Because that's usually what's oftentimes overlooked by most VCs. But for example, that's something that I try to show very hard. And then last but not least, this is something that is being way less talked about, is exit opportunities. And so whenever I do due diligence, I try to also pinpoint, okay, in what ways, in what scenarios could this company eventually be exited? And I also ask the founders that. And for me, I'm going to IPO is not an answer. That's a stupid answer, because it's by far the least probable outcome for any startup. So I look at which strategics could potentially buy that, for which private equities that might already have venture capital investment arms could that eventually become a potential buyout merger target. I look at their portfolios to see which of these companies could potentially buy it. And that's how you then also can create confidence in the exit, because that's ultimately what these family offices are after. They want to understand, can I ever make liquidity out of it? And that's how you can try to convince them about that.
Excellent. We've got a question here with Reza. Yep. We got, yeah.
What is the ticket size range that you have experience with that in terms of investment with these family offices? And secondly, in your experience, do entrepreneurs ask for too much money, too little money, or the right amount of money?
So I have to say I'm mostly doing early stage investing because that's where I feel I can provide the most value and also what I like the most, because if I wanted to do growth, I'd rather do private equity. So in early stage venture capital, I've done everything with families or family members from as little as 50,000 up to 3 million was the largest one. So very small tickets, but it's early stage venture capital after all, right? The second part of the question was, can you say again, sorry?
Do the entrepreneurs
For too much money. So,
too little money?
So really depends. Funnily enough, what I see is usually when the traction isn't there yet, they tend to ask for too much money, in my opinion. And when suddenly the traction takes off, they're becoming too scared to ask for a lot of money, which is another cultural difference to the US, right? And that's at least, in my opinion, how it is. And for me, in the end, it's not about money, right? It's about what next milestones do you have to achieve to either become profitable, become exitable, or be able to raise another round. Because, in the end, I don't care about big round sizes or big headlines. I want to see the money being put into action in the best, most efficient and dilution protective way possible. So that's also what I try to always instill with entrepreneurs and really ask them, okay, what are the milestones that you want to achieve? Really ask yourself, what needs to be done? How many people do you need to hire for that? And I'm not an entrepreneur myself, right? I've never founded a company, so I can only do so much, but at least what I've learned in management consulting and private equity is exactly always think equity story. Always think how can you achieve the next milestone, the next level, and then work from there. And that's what I try to instill also in the investments that I do.
Excellent. Last question, Paul Howard of Baltic Hydrogen.
Just for the entrepreneurs in the room, but also some of the investors, what do you look at in terms of successes in your portfolio, and what has been the driver for those? And to put that in context, has it been much active involvement from the family offices in those businesses? Has it been using their network to bring those businesses into a successful position, or put people in those businesses, for example?
Yeah. So I think really the best successes have been the ones where I was not involved as long as I didn't need to be, and then once I got involved, I got the right people in, as in the right families in, to provide the right contacts and the right POCs, basically, particularly for customer acquisition. Those have been the by far most successful ones. And again, I'm still at the very beginning, I would say, also of my own investor's journey. But one thing that I've always admired with much more experienced professionals that I saw is that they weren't pushy with their founders or their management teams. As in, they wouldn't interfere when they weren't asked to, only when they were really seeing that something basically got overseen and overlooked, where they could provide additional value, and that they would really then write the right email at the right point in time, and not jump the gun too early as well, because with many of these corporates, for example, you only have one real chance to make an impression, right? So you don't want to be too early. If the product is not ready, the service is not ready, also if you can't handle the volumes. How many times you see then suddenly somebody coming up with crazy order amounts or wants to use so much of your capacity, and then you have to tell them, I'm actually not ready to do that yet, right? Mm-hmm. So that's another thing that's, I think, super important, is this whole timing of making those connections. And whenever I was able to do that in the best way possible with the right timing, that's where real value was created.
Excellent. Listen, thank you, Kilian. Really valuable to have you with us. I really appreciate you coming. Thank you.
Thank you so much. Thank you, guys.